Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Yadea Group Holdings Ltd. Annual Report. Yadea Group Holdings Ltd. is a leading investment holding company that specializes in the development, manufacture, and sale of electric two-wheeled vehicles and related accessories under its renowned Yadea brand. The company operates in two primary segments: electric two-wheeled vehicles and related accessories, and batteries and electric drives. The company's product offerings are diverse and extensive, including electric scooters, electric bicycles, batteries, chargers, and other electric two-wheeled vehicle parts. In addition to its core products, Yadea Group Holdings Ltd. also provides technical services and sells consumer products. This comprehensive approach enables the company to cater to a wide range of customers and establish itself as a prominent player in the industry. Furthermore, Yadea Group Holdings Ltd. has expanded its reach beyond China by operating stores in Thailand and exporting its products globally. The company's products are sold through various channels, including distributors, third-party e-commerce platforms, and offline customers. This strategic approach to sales enables Yadea Group Holdings Ltd. to tap into new markets and increase its market share. In summary, the list of businesses and services provided by Yadea Group Holdings Ltd. includes development, manufacture, and sale of electric two-wheeled vehicles, related accessories such as batteries, chargers, and other parts, technical services, sale of consumer products, exporting products globally, operating stores in Thailand. Yadea Group Holdings Ltd. market capitalization of $40 billion is materially smaller than most of its industry peers of roughly $144 billion. Yadea Group Holdings Ltd. trades at a lower price-to-earnings ratio of 12 times and a higher price-to-book ratio of 3.39 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.99%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for electric vehicles and related products are multifaceted. Electric bicycles have seen a significant increase of 34.4%, followed closely by batteries and chargers at 32.1%. Electric scooters and two-wheeled vehicle parts have also experienced substantial growth, with increases of 28.2% and 36.3% respectively. Higher sales volumes and optimized product mixes have contributed to revenue growth, as well as increased investments in research and development, marketing, and brand-building initiatives. Strengthening brand positioning and engagement with younger consumers has also played a role, particularly through cross-industry collaborations and international expansion into Southeast Asia. The growing demand for electric two-wheelers, driven by global decarbonization initiatives and supportive government policies, has further contributed to revenue growth. In contrast, the primary drivers of revenue decline are not explicitly stated in the provided summary, although it is noted that the two-wheeled vehicle segment saw a decrease in revenue from $27.7 billion to $35.5 billion. The financial performance of a company has shown significant improvement over the past year. Net income has increased substantially, rising by 64.9% from RMB 4,289 million in 2024 to RMB 7,071.4 million in 2025. This substantial growth in net income is a testament to the company's ability to generate more revenue and manage its expenses effectively. In addition to the increase in net income, profit margins have also improved significantly. The gross profit margin has increased by approximately 25.7% from 15.2% in 2024 to 19.1% in 2025. This improvement in profit margins is a result of the company's ability to maintain its selling prices while reducing its costs, thereby increasing its profitability. The company's financial performance is a significant indicator of its overall health and stability. One key metric that highlights the company's financial strength is its ability to generate positive operating cash flow. According to the provided information, the net cash from operating activities in 2025 was RMB 2,311,119 on page 4. However, upon closer examination, it becomes clear that this figure is not entirely accurate. On page 21, a more precise and detailed calculation reveals that the company actually generated a significantly higher amount of positive operating cash flow in 2025. The net cash inflow from operating activities was approximately RMB 5,989.8 million. This substantial increase in positive operating cash flow suggests that the company is not only generating sufficient revenue to cover its expenses, but also has a considerable surplus to invest in growth initiatives or pay off debts. This is a strong indication of the company's financial resilience and ability to sustain itself over time. The company's financial performance has undergone some notable changes. While the total liabilities have shown an increase of 23.2% from RMB 15,860,819 to RMB 19,534,786, this growth is not considered significant. However, a substantial rise in interest expenses has been observed. The interest charge for borrowings increased by 88.5% from RMB 011,313 to RMB 021,433. Additionally, finance costs rose by approximately 28.4% from RMB 36 million in 2024 to RMB 46.2 million in 2025. The increase in interest expenses is attributed to proactive treasury management measures and the placement of bank deposits with maturities over 1 year. The performance of various segments and regions within the industry has shown mixed results over the past year. On the positive side, electric two-wheeled vehicles and related accessories have seen significant growth in revenue and gross profit, increasing by 25% and 72%, respectively. This segment's success is a testament to the growing demand for eco-friendly transportation options. In contrast, the two-wheeled vehicles and related segment has experienced a decline in revenue, dropping by 73%. Furthermore, the batteries and electric drive segment, while showing an increase in revenue, has seen a substantial rise in cost of sales, resulting in a lower gross profit margin. These results indicate that certain segments are struggling to keep pace with market demands, highlighting areas for improvement and potential opportunities for growth. Management is projecting a strong company outlook, driven by market trends and strategic initiatives. They expect revenue growth through technological innovation and sustainable mobility. The electric two-wheeler industry is seen as having long-term prospects for growth, supported by stable demand, expansion into new segments, and international development. To achieve this growth, management will focus on improving manufacturing efficiency, strengthening supply chain management, and maintaining disciplined cost control. They are also taking proactive measures to maximize returns on surplus cash through treasury management activities. Furthermore, the company plans to use net proceeds from a recent placing for expansion of its overseas business, including building research and development centers, manufacturing facilities, distribution networks, and potential mergers and acquisitions. Overall, management's strategy is centered around pursuing sustainable and balanced growth through innovation, efficiency, and strategic investments. The company has a history of paying dividends to its shareholders. For the year ended 31 December 2024, it paid out a final dividend of 22 HK cents and a special dividend of 23 HK cents. Looking ahead to the next financial year, the proposed final dividend for 2025 is set at 53 HK cents. This payment is expected to be made on Thursday, 16 July 2026. It appears that the company has not provided any information regarding share buybacks in its available data. Concerns have been raised regarding inventory buildup, indicating potential issues with supply chain management. The data suggests that this problem is significant enough to warrant attention. Specifically, trade and bills payables increased by approximately 18.8% due to suppliers as a result of the increase in purchases of raw materials. This indicates that companies are struggling to manage their inventory levels effectively, leading to potential disruptions in supply chains. That concludes the financial summary for Yadea Group Holdings Ltd. Feel free to comment below, and I will be happy to answer them when possible.